Hello everyone, this is Juan Sarmiento and today is Friday, June the 30th. Let's take a look at the positions we have and then we consider a few trades, okay? Let's go with Adobe first. Hitting new highs, they reach earnings that beat expectations by a wide margin, so I enter a trade here. And the way to look at it quickly is you can see your current place. I analyze the opposite and see how much money, well, it's been underwater, but that's okay because the expiration is on the 14th of the front month option. So we don't need to do anything, just wait until we are about a week to expiration, which will be next week. Let's go to ISRG. We can do the same thing. Go to the monitor tab and say, go back 30 days, and then you see even further back it seems. And go 130 days, and you can see that I made many adjustments. But let's go over here and see that we have $620 below. Well, let's look at the year to date. We have nice profits. Okay, so the way to do this will be to because there are so many parts here, make sure you go to the trade history rather than the order, and then you make an account of your position here. Let's get a calculator here, and I start with the price of the original trade, which was 47.10. Okay, clear memory and store it, then subtract 350. As long as the number of options here, the two options, you say what is the common denominator here is 2, which coincides with the common denominator here, and so you subtract 3.5. So minus 3.5. That's the new price after this adjustment. Then we have another one here of $4.20. You adjust that as well. So I'm going to do that for all of them. So 4.3, 43.6 minus 4.2. Then this one here, same thing. This looks like a vertical, means I took profit on the way up. You can see that I sold 2 of my 295 calls and bought at a higher strike price. So that's why we get so much money here. And we subtract that as well. Minus 28.8. That's 10.57. So my original price was 47. Now I have 10.57. And finally, this one here, which was a simple rollover from July to June. I have not done anything with the puts. That implies to me that the stock went up so much that the puts were left behind, so to speak. So I'm going to subtract minus 1.4, and that's my final price. Okay, copy that number and go to the trade here. Analyze closing, or maybe we just copy this and then adjust. Here we have 4.95 put for July. We have 2.95 calls, and that is for July as well. And then short, that's the 14th of July for the 295 calls. And then the last is this one here, which was the roll up. So it is really positive, and that should be July, and the price is 335. Okay, and so my price is that price that I calculated, and there it is. Then I hide the simulation. Yeah, according to this is 9,000. Something went wrong here, but anyway, this is my, you can see at least the price here. And oh yeah, put becomes actually calls. Okay, that's a little different, but still too much. Let me see. Yeah, something is not quite right here. Another approach will be to copy all these trades, take it to an Excel spreadsheet, and make the accounting. I think the best thing to do is for me to see what is my P&L for the year is 1.720, and then adjust that price. I'm not going to do that because it would be a waste of time, but you get the idea. I'm sorry that I did this all wrong. Okay, just disregard that. Here we have, you see the stock is trading at 342, and my calls here, my lonely calls are at 335. So we can definitely sell one, and the other we can roll it up, or we can roll up both. Analyze rolling. So I'm going to go same expiration, July 21, and I'm going to go to, let's say, 345 if we have that. Let's see if that exists. Yes, and then I get a big credit. You see that? Okay, but I want better than that. I want to reduce my deltas. To neutralize the deltas, I can simply buy only one, sell two, buy one, which means I reduce my outstanding call by one, and that gives me, let's say, custom, and we're going to sell two, and that gives me a lot of credit back. Okay, so that way we release much of the money in the trade. There, filled, and then we can see what the current value of that trade is $1,500. Okay, which I'm, that means we collected, we removed most of the trade from that. Okay, so that's a way to take profit, and we're still in the trade, we're still delta positive. So if the stock continues to go up, we make money, but if it collapses, then we have the opportunity to make money with the other options. Okay, let's move on to Oracle. Oracle is doing not so good. Let's see, monitor tab, here it is. Obviously we have had other trades on Oracle before, so we have this here. Do I need to adjust it? Hide position, and this is our current trade, and yeah, it's been a loser. July 14th, we still have 2 weeks to go. You never know what could happen in 2 weeks, so I'm going to leave it alone. And now I'm going to go to PA, that's Palo Alto Networks, and obviously I already did a roll up to 250, and now it's 255. We're going to do the same as we did for the ISRG. We're going to say analyze rolling. This is the only options that are loose, outstanding. You see how the two calls match the two calls, the two short calls match the two long calls. These are the ones that are on their own. So we're going to roll them up and sell one of them. So analyze rolling. Show me that. Here it is. Hide the position in this. This is my current position as it stands, like this. Okay, so what I'm going to do is I'm going to buy one at 260, let's say, and sell two at 250, the September ones. Okay, so I'm going to say custom, and I'm going to sell those two, but I'm buying only one back. Okay, and that, currently my deltas are 46.6, so when I do that, it goes negative. Well, I don't want it to be negative, really. it is at the top right there. It's very, very, very high. So a collapse could occur in one of those. You know, it seems like a little overpriced based on the charts. Okay. How about if we did the 255? That's not available, so you have to be 260. If we did the two of them, meaning we bought the two at 260, it is still delta positive 34, and that I'm happy with that. 34, 35 is okay. So we need to change this to September, of course. Okay, let me change that to 1 again. Yeah, it's negative 20. That's pretty much okay as well. So yeah, I decided I'm gonna do this. Gonna go buy one call up to 60 and sell the 251. So that's profit taking mode. Confirm and send. Okay, we'll see when it gets filled. Okay, I have some trades, potential trades here to consider. AVGO is one of them, FedEx, and then we'll examine them, okay? LRCX, AVGO, it's too expensive, LRCX too expensive, FedEx might be okay, LEN and CRM. These are the ones that I consider. Okay, so let's go by price. Okay, AVGO is obviously too expensive. If I were to do one, it would cost me, you know, at let's say the 870. It's just too expensive, okay? If you have enough capital, it's better because then you have less options to deal with. I sort of prefer that. And you go, which one would you sell? Well, I would say the August 4 and buy something like 9 weeks to expiration, 90 days to expiration. And we don't have them, it's not available. Let me see. What would be 90 days to expiration? I'm just doing this for the exercise. Well, you can do October 20th, that's 112 days. But those are not available either. So what do they have? Well, bottom line is too expensive, really, because when you do this, this is going to cost you. It's not available, so let's see. We have the 880 or the 860. When you get that high, not every option is available. Yeah, here it goes. $170, so that's 17,000, and that's more than 10% of my account. See what I mean? It's not available. The same will be with this LRCX. It's just too high. FedEx is a little better. Let's see if we were to do the FedEx. Let's go to the trade tab and look for the September, October, the strike price 240, 250 by custom Genie, then analyze that. And how much would that cost? $4,000. So in this case, it's potential we could do two of these trades. Okay, so let's examine that. FedEx, is that a good idea? Let's go to the chart first and see the stock is hitting new highs, the volatility is low, which is good, and they beat expectations by not a big margin, but it's still, because of the movement, sounds good, doesn't it? Okay, volatility is low. So then we look at the trade itself. And I'm just going to mark 2 here and then save that. Just say save, and here it is, FedEx, and analyze that. Okay, first we need to see what is the volatility. Well, you can see that the front month 28-21, the average will be something like 25, while the short ones will be 22, something thereabouts. So the skew is not favorable, and that probably eliminates this as well, because we want to sell expensive options and buy cheap options, and that means the volatility. High volatility means expensive options. Low volatility means cheap options. So yeah, I'd rather not do this one. So let's move on to LRC, to CRM 212. Same thing. Okay, let's look at the chart. Earnings. They beat expectation by a wide margin. That sounds good. The stock has been moving sideways, which to me that's a triangle. A big move in either direction is bound to happen. Volatility is at the lower end, which is good. So let's go and see what the trade tab look like. With the trade here, November, would have to go to November, which is 140 days, and my strike price will be 210. By custom, Genie, and then analyze that. Okay, so what do we see? 33.26, the shorts are way down, and I think we're going to find that the volatility on the front month is low versus the back month, and that means too expensive. Okay, too expensive in the sense that we are getting not much money for the short options, and we have to pay more money for the back month. Let's do the calculations since we are here. Here, first we average the 2 front back month options. So let's clear that, and we say 33.94 plus 26.11 divided by 2. 23. No, that can't be. 33.9 plus 26.14. Okay, divided by 2 is what's wrong with me? Okay, so I'm going to memorize that, and then we do the same for the front month options. 27.95 plus 23.93 divided by 2 is 25. So if we subtract from memory, you see that it's 4%. That's too much. That won't work either. I don't like the skew, and that's sort of a deal breaker for me. Let's look at LEN. LEN, again, doing well, new highs, volatility is relatively low, and you can see that they beat expectation by a wide margin. So yeah, let's go analyze. And here's a potential trade. No, let's create a new one. Go to the trade tab. And here we have November 140. My strike price 125. My custom Okay, 30, 23, 24, same thing. The options in the back month are too expensive. Okay, and we're gonna find that a lot. So it doesn't seem like a good time to be doing the Gini trade because of that volatility skew. So we're gonna let it be, and we wait until things improve. In the meantime, we have our trades and we're doing well in that end. So far this year we have a loss of $3,000. But it seems like we're recovering, so stay tuned. Thank you very much for joining me. See you next time. Bye-bye.